everyone. Thank you for attending the Place Your Trades Network Spaces. This Spaces is brought to you by TraderBait, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can now trade these on the DOM on TraderBait's main platform as well. It's a great way to get exposure to the futures market with limited risk. You can use the link in my Twitter stream to get the TraderBait app for free. I also write a weekly blog and daily pre-market overview on the markets that you can subscribe to at placeyourtrades.com. And that's free, obviously. And then I'll be doing a summary of my key takeaways that will be available for download as a PDF. If you're interested in getting this PDF, click on the link in my feed or visit placeyourtrades.com/spaces to sign up for it. And I'll also put it in the nest. And the PDF will be available and emailed out to anybody that signs up. And now on to the show. So I'll introduce our guest first. We have Kem Karzan. Kem is the founder and CIO and managing principal of Kai Volatility Advisors. He's responsible for portfolio construction and firm-wide management, as well as its head of research and risk management. Mr. Karzan formed Kai Volatility Advisors over two decades of experience building industry-leading derivatives businesses. At its peak during the great financial crisis, Mr. Karzan's proprietary market-making firm, Precision Capital, represented approximately 13% of the daily volume of S&P 500 options. In 2010, Kem divested his stake in Precision Capital to found his own investment firm, which is now Kai Volatility Advisor. Next, we have deerpointmacro. Deerpoint has a background working for global asset management firms and mutual funds, covering a wide range of funds from emerging markets, oil and gas, bonds, equities, and growth. And he has recently made a transition into credit. Then we have YraHarris. Yra has been in the markets for decades and is a literal icon. I can let him tell you a bit more later, but I will mention that he writes a note called Notes from the Underground that is fantastic that he posts to his Twitter feed. So I definitely say you go check that out. And now with that, we will start. I usually do this in a round. Deerpoint's been here before, but Kem and Yra hasn't. So just so nobody's sitting, not talking for it the entire time. So we'll do 2 rounds of questions, then a final thoughts round. And obviously, if you've got any comments on anybody else's comments, feel free to comment. And, we can make this as round table as you'd like it to be or not to be. And with that, I will start with Kem. So first, everyone's always asking about these 0 DTEs. So I have to ask, just given the rise in popularity and the volume, how has this affected markets at all, if any? And they were just opened up to European markets. Will that have any impact?
Yeah, so first of all, thanks for having me. Always great to kind of hop into a new forum and get some new voices in the mix. As it relates to 0 DTE, I think it's more complicated than what you hear in public media, not surprisingly. The reason that the shift originally began is because last year, realized volatility performed incredibly well relative to implied volatility. Everybody was hedged in implied volatility, 30-day on out options, and that caused a massive compression of vol into the decline that we saw last year. And so hedgers began to go much more into hedging realized volatility broadly. That's how it started. But volume begets volume. And I think we all know what the Wall Street bets kind of crew. Once stuff starts working, people start diving in to the new thing. And that's why we saw even though we saw a 40% increase, a move of 40% of all volume moving to 0 DT. What people don't talk about is the reduction in volume that happened at the same time in other non-0 DT options during that period. And I think that very much speaks to the transition from one to the other. That's how it started, okay? But what ended up happening is, as people started doing that, right, the reflexive power of options kicked in, and guess what? It stopped. Realized vol stopped working as well, and you started seeing a now compression of all volatility. Realized volatility itself also kind of compressed, and then people became, as people do. The reason dealer positioning gets bigger and bigger is because things start working and people crowd in, and then it stops working. This is how kind of trades work, and particularly in the derivatives and options world. So quickly, the hedging turned to a significant amount of selling by speculators in those zero DTE, and what that has done is, not surprisingly, compressed realized volatility, particularly short-dated realized volatility. Now, this is where we are. Now we've gone from people not hedging in longer-term vol, right, like 30-day on-out vol, to hedging in zero DTE, to then that not working, to then broadly starting to sell and not hedge there. I mean, this is a general progression we see historically. Eventually, things that aren't working, people stop doing, which reflexively leads to more short vol positioning, which eventually implodes. I think XIV, in 2018, the vol apocalypse. There's a million examples of this. It's almost like a sine curve vol positioning. Whether it's August 15. All the short positioning that led to that really big vol spike on the yuan devaluation, or you go to, again, vol apocalypse in 18, or again now Feb 2020, and the COVID crash. These are all vol intensive periods when short vol positioning is in the market, and that tinderbox is packed full and ready for kind of a spark. But just as equally, there are periods like we saw last year where vol is very well hedged, and despite a decline in markets, vol does not perform. So that's kind of how I would broadly lay it out at the current moment, though. The fact that the volume has moved to zero DT and is broadly short means that it's exacerbating one-day moves. Dealers are being forced to hedge on a one-day basis. More dramatically. And that's why more recently we're starting to see some of these bigger one-day moves like we've seen and quick reversals like we saw today, for example. Those are a function of more short zero day expiration, shorter gamma in dealers' portfolios. And that's changing market structure. But I would say broadly that is moving in real time. The more that happens, the more losses happen there, and how people will crowd, I'm sure, back the other way. But at the current moment, short gamma in dealers in the zero DT specifically is the trade. Last thing I will say, Tracy, is the important other side of that coin is we have less short vol behind the zero DT, and so as these things expire each day, everything resets. And in my opinion, long-term vol positioning, short vol positioning is actually the most dangerous structurally for markets. Think long-term capital management. The words long-term are in there for a reason. Things that are marked like that are long-term options are marked to market and can go anywhere. Much like oil could go to -30. Options, put options can go to infinity if people have to buy them back. And so ultimately, the longer short vol positioning is more structurally dangerous to markets, even if zero DTE can exacerbate short-term moves. I'll leave it there.
And do you think, let's talk a little bit more about volatility. It seems that markets have been more volatile this year, not in terms of the VIX, but just in terms of bigger market moves this year. Do you think this is due to rising interest rates? I mean, we've even seen this in individual equities as well, right? We've had a lot of, you just take a look at like oil stocks that have been up and down, and that's kind of been the case for a lot of these sectors. So do you think this is due to rising interest rates or general market sentiment, and do you expect this to continue?
Yeah, to be clear, it's always a function of both. It's always a function of macro flows paired with market positioning and structured kind of risk in the market. So it's always a push and pull. Right now, this year in particular, I'll highlight that, honestly, volatility at the index level has not been very high, right? It's the volatility of the single name assets. It's what we call dispersion. Dispersion is at a record this year, in line with the last time we saw a record in 2017, which these periods are all within, if you look at 125 years of market history, are out of line very, significantly from any previous history. Why is that? Why are we seeing really weird relative to bigger historic kind of, data sets, outliers in dispersion? The reason is there is a greater amount of trading and vol supply at the index level, which is pinning the market and holding things at bay at the broad market level, while the macro flows are really forcing still significant volatility for non-vol centric assets. When that happens, what you get is a situation by arbitrage constraints. If the index is not going to move, but some asset, whether it be Nvidia or oil or whatever it is going to move in a significant amount, by definition, other assets have to move the opposite way. Arbitrage says that if the index isn't going to move, its constituents, right, have to still together not move, even if some of them are moving, which means, again, they have to move away from each other, which increases the volatility and the rotations in the market. And we are seeing historic rotations, whether it's tech versus value versus growth, whether it's small cap versus large cap, commodities versus tech, you name it. We're seeing dramatic historic rotations that we have for several years now. And again, that's because of an increased supply of implied volatility to dealers at the index level on a structured product basis.
Forgot to unmute myself. You recently talked about the tug of war on flows versus macro on a podcast. Can you talk about this for a little bit?
Yeah, I mean, again,
and what you mean by
absolutely. Yeah, again, it kind of ties into the same idea. So let me dive into the structured products. I don't want to just skip over that. The structured product reality is an interesting one that nobody else is really talking about. It's very critical to what's happening to markets right now. Usually, first I want to make sure I explain here, as interest rates are increasing, right? Historically, if you look at the last time we've had a secular increase in interest rates in the 1970s, there were no derivatives, right? There were no structured products, at least not massively consumed. What happened during that period is what happens usually when interest rates go up. People move to bonds, right? So you're getting a higher yield. This is a macro liquidity flow that happens. This decreases the demand for risk assets historically, lowers multiples in the stock market, and again, it is a natural flow of assets into the bond market as interest rates go higher. However, this time around, we have a very unique, different thing happening structurally. We have what are called structured products. You have derivatives. And instead of just moving into bonds and T-bills, people are actually looking out there and saying, well, I'm getting 5.5% in T-bills, but I can what's called return stack or yield stack on top of that. I can go sell a put 2 years out, 30% out of the money, and collect an extra 2.5% a year. And guess what? I can also sell a call, maybe 30% out of the money, and get another 2% a year, and all of a sudden I can make 10% a year, non-correlated, right? In this type of structure, those types of products, and there's all kinds of versions of it. I'm overgeneralizing here. Create a vol supply and are creating a massive supply to dealers, because dealers, banks, issue these structured products, and they get the implied volatility onto their books. They have to hedge this implied volatility, and they have to sell this implied volatility, which is generally tied to the S&P 500. This amount of new vol supply, there's a ton of sort of structured product issuance happening, and a huge move towards these things that's driven by higher interest rates, is ironically compressing implied volatility as interest rates go higher. Historically, the opposite happens because there's less liquidity in markets. Volatility on the implied level generally increases. So you're getting this very counterintuitive structural effect that's specifically tied to the S&P 500 and other major global indices where structured products are issued. And it's causing a very, very unique vol compression at the index level, and that's driving this dispersion. So it's important to understand that effect that's happening. That's causing, however, a bunch of confidence in vol compression and vol selling. It's causing the success of vol selling. Eventually, there'll be so much vol selling outside of the structured product and in weaker hands and structured funds that eventually, and it always does, that will find a way to undo itself naturally. But at the current time, that is a very important structural piece. So that is a structural flow. When I talk about flows versus macro, that is a massive structural flow that is pinning the market, that is controlling things. When you have vol compression like that, it also drives other positive flows. I often say that, time is not a bear's friend. Why? As vol is compressed, if nothing happens, markets have a general trajectory of going up. There are a bunch of structural flows and reasons that's true, whether it's vol targeting funds or any Vana and Charm, the things I talk so much about in terms of structural buyback from the carry trade that is sell put buy call and dealers books. There's a million reasons why markets naturally trend higher into vol compression. And so those are structural flows. In the background, however, you have the macro picture, which again, from a liquidity perspective, the Fed continues to be behind the curve and to have to keep coming back into the fray to increase interest rates in the face of what is not a transitory structural inflation. Never mind all of the other global risks and things that are happening out there in cross-national flows. So this is kind of when I talk about flows versus macro and the push and pull we're experiencing. This is kind of the bottom line on how all of that works.
Thank you very much. Now I'm going to come back to you. I want to move to Yra. I want to talk about kind of the Fed and the bond markets here for a little bit. There was just an article out today about BOE facing major losses. I guess Deutsche Bank said the Bank of England's losses on bonds brought to shore up the UK economy will be materially higher than projected. So is this going to be a big problem? Is this going to cause contagion? Are we going to see like a repeat of September 22?
Okay, so Tracy, let me just say, pronounce it Ira. I know that's with the Y, it's confusing. It's been my whole life. So
Sorry, Ira.
that's okay. Believe me, again, the worst days of my life was having a substitute teacher in school because the name got butchered. But okay, so who said that about the Bank of England was going to suffer massive losses?
Deutsche Bank this morning just came out and said that.
Okay, Deutsche Bank doesn't know shit about anything, because Deutsche Bank should be much more worried about the losses that are going to compound to the ECB for the same reasons that they're raising for the Bank of England. But the Bank of England's intervention into the bond markets is the proverbial mosquito on an elephant's ass. And it's the same with the Fed. I'm sorry, I apologize for this. What was the name of the previous speaker? Because I found some of his insights very interesting.
It's actually Jem Carson. You can find me on Twitter, Jam_croissant.
Jem? Oh, okay. I see.
The C is pronounced like a J.
So
it's similar to your situation.
Yes, yeah.
All right, so I can't pronounce anybody's name today. At least Sorry, guys.
So in looking at that, and this is again my conjectures, what Jem brings up was very interesting, because there's a lot of volatility missing in the markets because the largest single entity that holds U.S. Treasuries doesn't hedge its position, and that's the Fed. But we're seeing volatility increase in the bond markets, just as we are with the Bank of England and with the European Central Bank, because as they do quantitative tightening, and I'll come back to the ECB, quantitative tightening will put more bonds into the hands of those who have to be hedgers at some point, right? And we saw the lack of hedging and what it does through Silicon Valley Bank, through First Republic, because these, they bought all those assets and put on their books because they were chasing yield. And the history of debt markets is how many people make phenomenal mistakes chasing an extra 50 basis points of yield. I mean, over my almost 50 years of studying and being a trader, because my academic work was highly involved with this back in the 70s. So I saw those comments very, very interesting. And Jem's point too about no derivatives in the 70s, right? Well, we also didn't have a central bank that built a $9 trillion balance sheet in the 70s either. Of course, that would have been fine in the face of it. Monetary policy was totally, it was trying to curb inflation where we got into this situation purportedly trying to prevent deflation. So those who compare these, and I like Jem's analysis of that because there were certain derivatives that were coming onto the scene, of course, in the 1970s, early 70s. Leo Melamed at the CME with Milton Friedman put together currency futures, which were a form of derivatives on how to adjust for interest rates and bad government policy, by the way, because the U.S. dollar was going to suffer because of very poor government policy. And then, of course, we have gold that for the first time since 1933, 1934, had become tradable in the U.S. for U.S. citizens. So we did have some structural changes, but I think Jem's points are very well taken. Is the Bank of England going to take a hit? Yes. But I would argue that they will relish having Brexit because the hit to the Germans and the Dutch and the Austrians from the balance sheet buildup by the ECB is going to far surpass whatever the hit is to the Britain. Now, you can tell me, well, yes, but on a proportionality basis to GDP, it won't be as great. That's not going to be the issue because the issue is going to be a political issue. And you see it in Germany happening now. By the way, people in Germany are very upset because they have they know that to join the EU, you had to surrender the sovereignty of having over your currency. But those who were leery about it never surrendered total sovereignty, which is the biggest problem in the EU. They don't have fiscal harmonization. There's no European bond. They used COVID in the best ways of Rahm Emanuel. They used it as an opportunity to try to create a European bond, and everybody was yelling, "Oh, this is great! This is a Hamiltonian moment for the ECB and the EU," but it never got big enough, and they really don't even know what they have to do with it. But the fact that everybody is still their own sovereign when it comes to the budget process is a real problem, and it will continue to be a problem. To just raise the issue for the Bank of England is disingenuous at best, in my opinion. And again, it's only my opinion. As I like to tell people, I said, it's a fairly informed opinion, but it's just an opinion, and it's a conjecture more than that. So, and the Bank of England will have to work around it. They've got so many other problems, but at least they're operating and trying to solve this on a synthesized format of fiscal and monetary policy. I don't know how the ECB is going to do it. And if we return to the U.S., the most important paper, again, it's just an opinion, offered up at Jackson Hole, and I've actually had the pleasure or non-pleasure of doing some podcasts with Barry Eichengreen. But Eichengren's paper was phenomenally important because it weighed out how the United States and presented it very directly how the United States is going to have to deal with, as I said with Rick Santelli in May 10th to be exact, that the deficit ceiling is just a sideshow. The huge debt buildup is the problem. And with rising interest rates and the higher cost of financing the deficit, that's going to be the issue, and there's no getting around it. And the Fed is saddled with just as great a problem, by the way. And there have been a lot of people who've been on top of this, Peter Bookvar, certainly Chris Whalen, and how this is going to resolve itself. So, this opens it up. But and I really I like listening to Jen because my weakness is in the option market. I mean, I understand the rudiments of the options market. I have a cousin, Victor Viner, who's a brilliant option strategist who's tried to teach me over and over again, but it is a hole in it. So I can't comment anymore about, the volatility in the options market.
And then I kind of wanted to talk about, well, since you brought up the Fed, so how hawkish do you think Powell is going to stay? And have we even felt the full effects of these rate hikes given the incredible pace of them?
No, we're starting to, and you can see how badly, and people are, I'm not a Powell fan because Jerome Powell and I can tell you, I had a pleasure to discuss a couple things with him very openly before he was Fed chair. And I didn't like the answers, but that's a different story. But in 2018, he was on the right track. But because the academics told him, and I'll get to why I cite the academics, because there are a lot of academics at the Fed. That's where PhDs, between the IMF and the Fed, it's a great place for PhDs in economics to find work. And there's all these studies that go on and on and on. And Powell got pulled by him. He knew in 2018 that he needed to start raising interest rates because they were seeing certain effects. And he made the categorical mistake. And it wasn't just me. And I can go to my blog, and I was very critical of it in real time. And I did a Santelli in July of 2018 saying you can't do quantitative tightening and raising interest rates at the same time. Raise rates, stop raising rates, and then proceed with quantitative tightening. Because we've never been here before. As Jim talks about, the 70s are nowhere near. We have all these other variables in play. So we've never been here before. And he did both. Why? Because Janet Yellen and Ben Bernanke had famously said that quantitative tightening and reducing the balance sheet would be like watching paint dry. And Stan Druckenmiller in November, December of 2018, called out Powell very openly and said, you've made a gigantic mistake because you've used a double shotgun approach by, of course, raising rates and quantitative easing, not knowing what the effects were going to be. So again, he panics. The market is, when do they panic? They panic over Christmas Eve because Mnuchin calls up all the big banks over Christmas Eve, checking to see who has enough liquidity. And then the markets really, on December 26th, 27th, start to shake, rattle, and roll. And then we get the famous Powell pivot in January of 2019 when he stopped doing both because they really didn't know the effects. And then we go on, of course, and then we get to quantitative easing, where Jerome Powell he's no longer wants to be the Fed chair. He wants to be the Minister of Social Justice. And his mantra was that the Fed was going to stay easy until everybody who lost their job through no fault of their own had a job back. So and the academics were telling them to stay the course, right? Then the mantra became inflation was transitory. So it is truly amazing that while we saw inflation creeping up to 6, 7, 8, 9%, whatever metric you want to use to do your measure, the Fed continued quantitative easing and doesn't end quantitative easing to 2022. What's going to be the whole outcome of this? We really don't know. But the cost of financing this deficit through the need to keep raising rates, and it is to save the Fed's credibility. That's the battle now. And while they were doing it, what became the battle cry? That Powell was finding his inner Volcker. Well, that's pure garbage. Because as I've maintained over and over again, first of all, Volcker was an absolute opponent of the 2% inflation target, by the way. You can go find pieces that he wrote in 17 and 18, citing it and why it was a mistake and adhering to it was a mistake. But Powell finding his inner Volcker, if Volcker in 1979, 1980, 1981 had to deal with a debt to GDP ratio of 100%, 102%, 95%, he could never have been Paul Volcker, because it would have brought the world to an absolute calamity, because they never could have gotten rates to 13, 14, 15, 16%, because it would have brought the world crashing down. The debt to GDP ratio in that period was 39%. And we as private citizens didn't carry as much debt. Believe me, I didn't get my first credit card till 1980 or 81, and I had to do that for business travel. But, I came from a family, it was anathema to have a credit card. The only credit card you had was at the local department store, and that was so my parents didn't have to put money into their 5 kids' hands to go get new clothes for school. We could use the credit card. But it was debt, public and private, was far different. So how far can we go here is going to be the operative question. And as Eichengreen's paper from Jacksonville, we don't know what that ceiling is, but I guarantee you we're close to it. And I used a metric of my dear friend Kevin McCarthy, not Kevin McCarthy, the Speaker of the House, Kevin McCarthy, who I went to graduate school with, who's really a great student of the international economy and all its effects. And we've talked about this probably for 2 years. What is going to be the political fallout when the interest cost of financing the debt exceeds the defense budget? And you know what? We're here far faster than anybody thought. And even lately, and I don't have a lot of respect for their work, by the way, but the CBO, because it's all we got to work with, is really amazed at how fast the interest costs have gone up in the last 4 months. So when Congress comes back and we're coming into a presidential election year, this is going to be a very hot topic.
Jim, did you have a comment or question?
Yeah, absolutely. So Ira, I couldn't agree more with some of the points, in the sense that this time it's different, in the sense that you have structured products and derivatives. You have a debt to GDP ratio that is dramatically higher. These things matter and will change the trajectory. So that said, I do think it's important to talk about what is also similar to the 1970s, and why these things will also still rhyme. We will not follow the same trajectory. We never do exactly, but there are elements that are very important to understand about the 70s, which I know you'll agree with, Ira. But I just want to highlight those. One, the Fed, it's really not Powell that is going to save the day or not save the day. Everybody's talking about, is Powell the right person? Is he doing the right things? The reality of the situation is that the Fed, who is being asked to deal with a structural inflationary problem with only cyclical tools, is almost it's almost impossible for them to deal on a short-term basis with the problems at hand. What do I mean by structural versus cyclical? We, from 40 years of Fed-dominated monetary policy, have borrowed from the future by creating massive inequality in the system. It's the same thing that we've seen in massive cycles before. We've created, through monetary policy, a supply-side economic model where we send money to capital, to corporations and wealthy individuals, and those entities invest that capital, which causes asset inflation and corporate margin expansion. All of that has led to more money for 40 years to the top 1%. This has created dramatic wealth inequality over the last 40 years in the United States. That is not within the Fed's mandate. The Fed is all about GDP maximization and price stability, and they had the benefit, if you're sending money to capital. I use the analogy, sending money to Planet Palo Alto. We've been sending money to this place out in another planet, where they just send the money, just goes away. It doesn't enter our economy, and what comes back are cheaper, more advanced goods from this advanced planet. And that is deflationary. We've been creating a massive deflationary cycle structurally, secularly, for some time, despite increasing money supply. There's a reason we had deflation structurally for that 40-year period. and we haven't had inflation for a period. The problem is the cost of that is, the labor here on this world. We've outsourced all our labor to Planet Palo Alto, and the people have not benefited. We've seen massive inequality. People over time do not like inequality, even if even if the ships get raised, the higher tide raises all ships. If some ships are dramatically higher than others at some point, those waves come crashing down. And that's what we're seeing here. These cycles go on and on, over and over. This is what happened in the 70s as well. It's not a coincidence that once these things happen, you start to see populism. That's what we saw in the 70s as well. That's what the Great Society program was all about. You see greater fiscal spending. You see greater protectionism, which drives more conflict globally. That's why we started a Cold War in the 70s. That's why we had a hot war in Vietnam. We're starting to see the same things: Cold War with China, hot war in Ukraine. It's also when you start to see entities start to protect the core assets of value, whether it be oil, like we saw an OPEC crisis in the 70s, or other things of value that country or those people, that populace, can use as a bludgeon against the other side. So we are entering a time of global conflict. We have seen this before, a time of deglobalization after 40 years of globalization. These things are structurally inflationary, and they are a function of inequality and the need in populism versus capitalism. And that is something that the Fed cannot battle with cyclical effects. This is the same problem as the 70s. Everybody says Volcker is a hero because he came in. I have this paper I wrote. You can go find it on my Twitter. It's pinned at the top, called Worshipping False Prophets. This idea that Volcker was this hero, this prophet that came and squashed the inflation. Baloney. It took 14 years of other Fed chairmen doing more or less the same thing, just to slightly differing amounts, and not succeeding. We needed 14 years to get through the structural elements and the issues that finally were in place that Volcker could succeed 14 years later. He was the right person at the right time. The reality is that the structural inflationary issues that we're seeing are a function of a rebalancing that will take time. And unfortunately, the Fed is kind of, spitting into the wind as it will be, as it is right now. And Powell has no choice but to try and do it in the short term, to try and control the inflationary structural realities of the world we're in.
Vera, did you have any comments on that, or?
Yeah, so let's say I love that Jem's analysis. Parts I'm not going to agree with, but the analysis, structural versus
Cyclical.
What's cyclical? Thank you. That's my old part. Yes, and it is. See, I come out of the 70s, and I think the Fed has relied, and you go back to Bernanke, the Fed has relied on the goddamn Phillips curve, right? Why Bernanke always talks in terms of output gaps. Well, when I was a student in the 70s, I thought the Phillips curve was badly flawed, because until they revealed to me what the assumptions they make in any model that they build, and from the way that I read it and the things that I was studying, because I was studying, my master's thesis was on multinational corporations from a Marxist and classical liberal perspective. So these are things that I looked at, and debt was certainly very important. The structural aspects, I mean, debt is always, to me, because everything starts with debt, but things were so different, and the structural aspect of, especially coming out of the Vietnam War. So again, we're always talking about what are we going to finance, right? And who's going to pay it, and who's going to be repressed by paying it. And I agree that your point is very well taken about the transference of money. I see it in myself, and in my blog, I've been trying to get people to understand it over the last 2 years. 2 years ago, $1 million, and I can only make it this simple to you. $1 million T-bill got you about $3,500 in interest, right? 18 months later, that same $1 million T-bill will earn you $55,000 for a 1-year T-bill. Well, as you point out, that's a massive flow of money. But I would argue, if you were a saver, you've been repressed by design, by the way, by design, because you either are going to bail out the debtors or you're going to bail out the savers. Right now, we're bailing out the savers. And that's going to be part of the political discussion when Lizzie Warren and Sherrod Brown and then the conflict is going to occur because they're talking about it now. And then you have the the MMT crowd, they're going to discuss it also, because this is what Warren Mosler, who's one of the founders of the contemporary view for it, is going to discuss. And this is when, see, the modern MMT is really built on, as Warren Mosler always posited, on having a responsible electorate. That if the monetary policy made the economy too expansive, the electorate would push to raise taxes, which would curb any type of inflationary outcome. Well, now, no way. And as you point out, Jim, the Fed does not have tools to deal with it. They never have and never will. And the dual mandate is pure nonsense anyway, because when you're the world's reserve currency, we've proven over and over again, we have a triple mandate. Because the Fed will turn on the printing presses, so to speak. I hate that phrase, so I use it with trepidation. But they did it in March of 2020 with opening up the swap lines, which they needed to do because there was a global dollar shortage. And who gets hurt in a dollar global shortage? Those who are in the most vulnerable position due to a huge amount of debt that they've taken on. So the Fed had to step in. So it wasn't the triple mandate really created a much more dangerous situation for the Fed, because they could think about how they were going to rein this in. And as long as the COVID situation was plaguing the global economy, they had to answer with staying, as they talked about, lower for longer. So you're 100% right. The Fed they are caught in this situation, but now they're part of the problem of the fiscal problem, because that idiot and Adam Schiff, and in 2021, he was running around showing the check because the Fed had put back to the Treasury about 800 billion. Why? Because the Fed bought all these treasuries, and they were earning the interest on it, and they gave a check back to the Treasury and Congress. And Adam Schiff says, "Wow, this is great. We have money for the transportation fund, for the highway fund." And I go, "Well, if you believe this, then you've just created the greatest feat of alchemy ever. And you know what? I'm going to retire, because if the Fed could just buy all the Treasury paper that was issued and then take the interest that it earns and give it back, and that's how we're creating money. Yeehaw! I don't have to work anymore. I'm done. We have just created it." Now, the only ones who did it really intelligently, of course, were the Swiss. And and it's funny. We talked about the ECB. We talked about the Bank of England. We've talked about the Fed. The Swiss, because they when they did quantitative easing, and they were doing it to defend their currency from getting too strong as the world was coming unraveled. And the Swiss is always a depository, because they have a history of being sound money people. But they took Swiss francs, sold them into the market. They basically printed them the same way as everybody else, sold them in the market, and with the foreign currencies they bought a basket of 400 billion, 450 billion, 500 billion of global equities. They're the third largest holder of Apple stock. So theirs was done intelligently, as long as the world was willing to take what they had on offer. And now they have the ability, so if they want to unwind their balance sheet, they go in and they sell equities. And they've been earning dividends on that too. So it's a real. If I was a graduate student right now, my doctoral thesis would be on the comparison and contrasting of the way the Swiss National Bank did quantitative easing versus everybody else. But how is the Fed, now that they're a drag on fiscal policy? Why? Because the Fed, instead of making money, they are now running a huge deficit because the bonds they own, the longer term ones, what do they yield? 1.5%, 2%, 2.5%, maybe 2.8, maybe 3. But on a daily basis, they're paying out 5.4%. That's not a mechanism for for a good outcome. And you can say, well, it's the central bank; they can print money. That would be Powell's answer, because that's the answer he once gave me in his discussion about the ECB back in 2016. That's not a good outcome. So but the Fed is now adding to the fiscal crisis that looms in this country.
And thank you. I want to switch this up a little bit and talk about Brics with Deerpoint for a second here. So we had Brics added 6 new members: Saudi Arabia, Iran, Ethiopia, Egypt, Argentina, and UAE, which of course spurred talks of a whole new world order and death of the USD once again. But, you know, looking at this list, you have Iran, Ethiopia, Egypt, and Argentina, currencies in free fall. And KSA, Saudi Arabia, and UAE are basically pegged to USD. And we were on a podcast last week together, and you were talking about how commodities, because let me rephrase that, because of this situation, everybody's saying that Brics is now the new hub for commodities, even though the Brics Summit ended up with no new currency, which was no surprise. But we talked about how commodities being traded in other currencies, but you brought up the fact that it's really about invoicing. And so can you kind of explain this to people and what you mean? And you actually posted some charts that I will retweet on Twitter about this.
Yeah, thank you, Tracy. So, I think within the Brics aspect, one, there's kind of a lot of confliction. Like, people use the idea of settlement and invoicing kind of synonymously, but they're quite different. And it's a very important distinction. And so, like, kind of in the easiest way is if we were to think about what invoicing is. Invoicing refers to kind of a dominant currency paradigm where export prices are established in a widely accepted vehicle currency. And currently, there's 2 vehicle currencies that are kind of widely accepted for invoicing, one being the US dollar, which is most dominant kind of globally, and then the second one being the euro, which is more dominant like regionally, so in places like Africa, etc. But what else plays kind of a very important role in the idea of invoicing is something that is called exchange rate pass-through. And this is essentially measures the extent to which changes in exchange rates influence the prices of goods and services within a country. So I guess to even simplify that further, what you could simply say is it gauges how fluctuations in the nation's currency value impact the prices of imported goods sold domestically. And so this is kind of like a very important or a crucial concept in international economics, because it has ramifications for a country's inflation, trade balances, etc. It also, depending on how you have, whether you have increases or decreases in the value of a currency, it then changes the either increases or decreases exchange rate pass through. And so what you then get is, like, if you have something like, for example, let's say the Iranian talmand, or the Chinese yuan, or some of these other currencies, the rand, even the ruble, the implied volatility of these, the fluctuations would be too rampant to essentially have kind of a consistent exchange rate pass through. And then this leads to, if you have too much variation in exchange rate pass through, it can either slow global trade, and then it changes constantly kind of domestic pricing of exports. And so I think that that's kind of the biggest hurdle that nobody talks about. We can say they'll settle in whatever currency at the end of the day, but that's not really what's significant, because at the end of the day, all of that's being priced in US dollars, essentially, as the denominator, right? Like, I'll sell you 1 barrel of oil for $80. I might be settling that trade in yuan, so I'll just take, whatever amount of yuan takes to buy 1 barrel of oil at $80, and that'll kind of be the settlement. But the invoicing will still be kind of at least the denominator of those transactions will be the US dollar. And so I think that, that in and of itself is very significant. And then I put out a chart yesterday as well, where as if you're looking at a nation like Saudi Arabia has this massive dollar shortage domestically. So dollar liabilities are currently outstripping dollar assets. And obviously they're having debt outflows. So as these kinds of things start to happen, whether you start to drain FX reserves or you start to drain treasury holdings, it can lead to kind of this domestic problem where there's not enough collateral to kind of facilitate trade. Then that starts to worry investors. Obviously, in a country I know very well, which is Turkey, you've kind of had the same issue where FX reserves were falling as short-term external debt was mounting. This led to investors getting extremely worried and starting to pull money. And so when you start to look at all these nations that are entering BRICS, kind of with the exception of Iran, I think that this is going to start to become a really big possibility. And if they continuously have, outflows of capital, it's going to kind of put them in their own kind of crosshairs going forward, economically speaking. And then the last point that I'll end on is, the Middle East is a nation I know well. My father's from Azerbaijan. And I know the Iranians very well, just as a function of the fact that Azerbaijan and Iran are about to go to war like every other day. But, the funny thing was last week, Abd Malik al-Houthi, who's obviously the leader of the Houthis, came out and said that they want to start targeting the NEOM project with the back of missiles. The Houthis are not getting missiles from nowhere; they're getting them mostly from the Iranians. And so it's like, even on this stage of things that are happening, like this whole idea of the fact that Saudi Arabia and Iran are going to normalize relations. If you look at like kind of domestic news, no, you're not seeing that. About a month ago, Tracy, there was problems at the Strait of Hormuz, again from the Iranians. And so all of this kind of, clogs up at least domestic trade for a lot of the Gulf states, and obviously leads to a lot of instability and worry about security within the region. So I think a lot of this, if you look at the three of the six nations that joined, or I guess we could even say four: Egypt, the UAE, Saudi Arabia, and Iran. Iran doesn't really like any of them, and the other three don't really like Iran. And I think that those kind of sectarian as well as like geopolitical tensions are too deep to really be able to be like overcome by any sort of BRICS alliance. So I guess that's kind of where I'll end it.
Well, and that was kind of my next question, which was, China and Iran are getting very close. So what does that mean for Saudi Arabia? And is this a problem for cohesion in BRICS? But I guess you've already answered that question. So let's go to like my next question about this whole alliance is, what is the role of China in all this? And, what are problems facing, the Chinese economy right now? I mean, the yuan is also kind of in free fall or manipulated, even though you shouldn't say that. But the PBOC is having a hard time reining it in. So can you give us a little bit about what's going on in China? And do you think what's happening in China is going to cause some sort of global contagion, or is it kind of a controlled demolition of their property sector right now?
Yeah, so I'll kind of touch on this, and then I do have to drop. I have a phone call in the next 5 minutes, but I'll try to touch on this in two simplistic kind of terms. The one I think is China's in a balance sheet recession. And two, the next problem is I think that they're in a bit of liquidity trap. And so, I know that there's some people who are saying, well, China is spurring domestic consumption. We're not really seeing that. I built a model, I guess, to the beginning of this whole conversation on academic economics. And now I'm going to talk about the marginal propensity of consumption. But anyways, I built an MPC model for the Chinese, which is actually falling And so essentially what a liquidity trap is where, let's say monetary policy tries to lower rates in very simplistic terms, but you're not actually getting consumption, you're getting a hoarding of savings or the repayment of debt. And so, this is essentially what we're seeing within China. And so I do think that China's in a bit of a pickle. I'm not really sure what they're going to be able to do to continue to kind of be able to grow the economy. I mean, I'm a big believer in the solo growth model, and China's total factor productivity. I know we can even argue about that term in and of itself, but let's just kind of hold it as a constant. Has been declining. I think that this is leading to lower levels of output. They haven't really been investing a whole lot of money in their capital stock. As you mentioned, it's been going into other aspects, pretty much financialization. This has led to essentially less capital per worker. I think that their productivity levels are falling. China's had to become more and more indebted to be able to kind of sustain its nominal GDP projections, if we really believe those. It's about $2.30 of debt are needed to generate $1 of GDP for the Chinese, and for the U.S., it's about $1.40 of debt to generate $1 of GDP. So I think that what we're now seeing with the Chinese is this need to try to continue to facilitate credit growth to facilitate GDP. The problem is, the private sector, as we've seen from the total social financing numbers, which I think fell roughly, I don't have it right in front of me, but I think total social financing was about 4 trillion and then fell down to about 500 billion. From the prior month. So a massive decline of, $3.5 trillion in terms of where it was from the month prior. So, I just don't think that they have a lot of private sector demand. And, the only people that really have any sort of borrowing appetite's the public sector. But again, I don't think any of that's going to be really useful. And the fact that the private sector is trying to pretty much step away, I think is really the big crux of what we're seeing within the real estate market.
And thank you so much. I realize you have to leave, but I do really appreciate your time today. And then I'll move back. I just have a couple more questions for Jem and Ira. First, well, this question is kind of for both of you, so you can, whoever wants to go first. We talked a lot about this magical 2% inflation rate about on this basis quite a bit over the last few months. So I'd like to get your view, your personal view, and do you think the Fed will be be forced to have to raise its target inflation rate from 2%? I mean, because the way I look at it is what they're doing is actually making things worse if we're talking about, say, food and energy. And whoever wants to take that, one of you take it first, and then I'd like to get the other person's opinion.
Okay, so I'm not a fan of it, never been a fan of it. I know where it comes from, out of the Reserve Bank of New Zealand in the 80s when New Zealand was really struggling. Now, it was interesting to listen to Powell, because if you go back to 2020, another great mistake that Powell made was in Jackson Hole when he presented flexible adjustable inflation targeting, which was just a way of mean averaging inflation over an extended period. So if you ran inflation at below 2% for 60 straight months, you had room to run inflation hotter over the next period of time so that you would smooth it out. That was the whole thing. They dropped it. Again, another one of those academic polls on Powell, and he went for hook, line, and sinker because it kind of made his life easy, but again, a giant mistake. Now, if you get to the core inflation numbers, which I thought Powell was actually pretty good at this one, because he basically admitted, as Lagarde said it better, because she put it under 3 points of what the bank had to do: clarity, flexibility, and humility. And Powell was very humble, I thought, at Jackson Hole, and basically cut himself loose from being towed around by the academics. I think that's why he used that phrase that we're navigating by the stars in a cloudy sky. Now, I happen to know what that means because my father was a navigator on a B-24, and I was brought up on the stories of how difficult it was to navigate. It was great to fly with cloud cover, but it was very hard. And there are a lot of aircraft were always lost in cloud cover because they would get lost and wind up in places that were very bad for them. But it was a very humbling statement. And Powell talked about core inflation. Well, I'm going to tell you what, the Fed can't do, excuse my language, crap about food and energy prices unless they bring the economy to its knees. If oil prices are going up for all types of reasons, bad policy and preventing the drilling of what we need, or there's a war that breaks out, and if food prices, like right now, we're watching food prices climb. India's curtailing rice exports. Wheat is down, but of course, prices are way down from the highs that they made at the height of the Black Sea crisis last year. Grain prices are historically still holding up pretty high. But the only way the Fed can really do anything about food and energy prices, which is why we discussed a core rather than a headline, is to bring the economy to its knees. And that would mean if you want to get energy prices down by curbing demand, you're going to have to take unemployment probably to 8, 9, 10%. That ain't going to happen. If you think that's going to happen, you're living in a fantasy world. So I don't even know what this discussion, people put so much bank so much on it. I just don't see it. The only other way is through the fiscal authorities, Congress and the president, and that would be artificially capping prices to lower the impact, or as they did in Europe last year, send everybody checks to cover their increased costs. But that has an inflationary impact, and that winds up undoing what the Fed has set itself out to do. So I don't know how people think that the Fed can do anything with food and energy at all. So I'll stop there.
Jim, and your thoughts on this 2%?
Absolutely. Do I ever? So I think we need to back up for a second. Again, this ties into what I was saying earlier, and understand the decade and time that we are in. The realities of the situation are when you are in a Fed-dominated system, when the Fed has the luxury of its two mandates, price stability and employment being in line, which we did in that structurally deflationary period, right, where we could continue to print money and drive that to capital, to Planet Palo Alto. That is a structurally deflationary period that we can continue to stimulate into. And that becomes a two-dimensional game. That is a place of Fed dominance, and that is simply a cyclical game. Anytime we have a cyclical deflationary period, the Fed would just come in and print a bunch of money, right? Just do a bunch of QE and re-stimulate. And so the game is very simple. It's two-dimensional in that world, and that could go on forever if there were not human beings in the system. The problem with that is there are human beings, and at the end of the day, inequality that is driven by all this, the distribution of wealth, not just maximization of GDP, but maximization of median GDP starts to matter. When we get to that point in the game where we are currently, populism becomes dominant. And when you get to that point, right, politically, and politically means populist, political, politi, all of this starts to matter. And that's where we are. That is what Bernie Sanders and AOC were about. That's what Donald Trump and rhetoric is about. The world, the US, the whole system is demanding equalization, right? And normalization, and maximization to median outcomes, not mean outcomes. And that may sound like a very small thing, but that is everything. Because when we are in that point of the game, we go from a global cooperation game where corporations and profit is what matters globally to a local populace. People are local Governments care about their people, not the people of the world. And that leads us to a time of competition. And here we are, right? A time of global competition. And during times of global competition, resources of the countries matter. Strength and power is all that matters. It is no longer a two-dimensional game. There's not one dominant force and one dominant thing that drives cyclical outcomes. It is about who has what and what power, sources of power. And those sources of power accrue value, whether it's commodities or whether it's military might or financial might. Those are the things that begin to matter during these periods. This is what we see during inflationary times. And I bring this all up in the context of this 2% inflation target. You can have whatever target you want if you're the Fed during a time of dominance, of monetary dominance, because you have control. You are the 10,000-pound bully gorilla in the room, and you can control the system much like we did at 2% for 40 years without any problem. The problem is that Fed put, which was so dominant, is becoming dramatically less dominant and less powerful in a world where their two mandates are not in line. They now have to contend with all the other sources of power in the world. And this game becomes much more volatile, much less, the Fed put is much less dominant and much more in question. But there are other puts, smaller puts, being entered into this world of competition. Much like in the 70s, OPEC has its own put, right? And this is what ironically drove volatility in oil, despite what you might hear, down in oil markets. It was a much more one-sided market. Puts in, the OPEC put was very much a thing in the 70s, and we're beginning to see similar things happen in the resource sector. There are new puts, new sources of power underpinning certain asset prices. All of this has big effects on structural inflation. As I mentioned, structural inflation is going higher. This is what we've seen with core inflation. This is why core versus cyclical headline inflation matter. The real rate of inflation right now is significantly higher than 2% and not coming down, despite what you hear in the media, despite what you see in the month-to-month numbers. And that is what matters. And the Fed will be forced to raise their long-term inflation targets over time. We're already starting to see that movement in rhetoric. They will not have a choice. And ultimately, the real problem there is what that does to the credibility of the Fed and the diminishing power of the Fed put and the Fed's dominance as we move forward.
Tracy, can I jump back in there?
Of course.
Absolutely, and I agree. And they've been chasing their credibility. So I think Jem's point is well taken. And Tracy, you've heard me. I think when we first met back in on that panel with Santelli when I did that back in 2016, and it's been my mantra for a long time. In a fiat currency world, and yes, it is a fiat currency world, and it's been that way for 5 decades. So a central bank's credibility is everything because that's what you're dependent upon. And to me, gold, and I'm not a gold bug. Believe me, I'm the first person. I wish gold was back at $41.25 an ounce, because then the world would be in a much, much better place without all the piles of tinder that are ready to be lit. So the Fed is, as Jim talks about, it's chasing its credibility, and it sold itself. And a lot of it was they lived on a false premise, and that's what I was going to speak to before, because with the Phillips curve is a domestic-oriented model. But once the world changes after Vietnam, especially, and then you get Deng, Mao dies, and Deng comes on in China, and Deng sets China on a totally different path. We went, as Deng said openly, he had to defeat the two whatevers, whatever Mao theorized and whatever Mao wanted, versus Deng's clarion call was practice is the sole criterion of judging truth. Now that's science-based outcomes. That's not theory. So whatever proves to be, and that's what the course he set China on. And then, of course, 1989, we get the fall of the Berlin Wall, and the world truly opens up, and you have brought, at that time, 1.5 billion workers into the more capitalist based system, which controlled wages by the power of capital being able to arbitrage wage labor all over the world, right? That's what took place. And the Fed rode on that. So they could get away with a lot of mistakes, and a lot of mistakes from Congress and others in fiscal policy because of the impact of what Thomas Piketty talked about. R was greater than G. The rate and it was due to the ability of the massive amount of labor that came on that controlled wages. NAFTA was all about controlling wages. Go back and look at it. We were going to use cheap Mexican labor to keep pressure on U.S. unions and Canadian resources with a pretty good sized market economy with no tariffs, and that's what it was. And lo and behold, January 1st, 1994, NAFTA begins. It's the official start of NAFTA. It was crafted under George Bush and brought into action by Bill Clinton. And January 1st, on the same day that NAFTA started, the Chinese devalued the yuan 50%, from 5.8, where it was fixed, to 8.7 the same day. Now, you can think that it's coincidence, but then you don't pay attention that China is a very good watcher of global events. And they knew what NAFTA was about, and they underpinned it. And then we got to what Jem talked about before. By 1997, 1998, the huge amount of capital that went into the Asian tigers, as they were called, then begins to collapse in Thailand on July 2nd, 1997, and carries over. And then we get, of course, long-term capital due to what took place in Russia. So you have all these events, but the Fed was able to ride the wave of global, not disinflation, global deflation when it came to wages. And Jem is 100% right. I can't tell you you're right, but I 100% agree with him that this is what, it's what got Donald Trump elected, because the middle core of America, they didn't really get, outside of cheap furniture and cheap clothing from China, their wages, real wages, fell dramatically because the labor unions, which makes this time far different than the 70s when labor unions really had power, but they couldn't negotiate, and their real wages dropped dramatically. And you get and Donald Trump tapped right into that, and that's a populist view, and it's growing now. And I think that Jem is 100% right. When Congress comes back, there are going to be those who are going to talk about the huge wealth transference to the top 1% and what's going on. And that, there are a lot of economists on the left who say that's why demand is holding up here. It's the top 10% of the country driving demand, because all of a sudden they're recipients of this massive flow of money via interest rates. So the Fed has lived and been able to get away with, I think, a lot of policy mistakes because of that. And that's, and I'll stop there, but I just wanted to respond to Jem.
And thank you both very much for that. And do you have time for one more question before final thoughts, or no?
I have to be off in 5 minutes, but we can
All right.
maybe
So,
squeeze
all right, we'll go to the final thoughts round. So the final thoughts are, there are a lot of investors, obviously. This is the same question I ask everybody on every final round. There are a lot of investors on this. So in your opinion, can you give us what we should be looking at within, say the next 12 to 24 months, or talk about something that we haven't talked about yet that you would like to bring up? And we'll start with Jem, since you have to jump off.
Yeah, thank you. It'll be a riff on something I've already said. Next 12 to 24 months, look, it's a push and pull, as it always is, but between macro and flows. But no more. This is historic, as we see through the dispersion model that I explained before. So the real question here, the macro that we've just walked through for the last 30 to 45 minutes points to a very, very structurally dangerous, more volatile period with lots of leptocurtic fat tail outcomes, not just from a financial perspective, but importantly through a global populace perspective. Conflict and competition is where things are going, and that is a dangerous time broadly for the world. It was a dangerous time in the 60s and 70s. It was a dangerous time in the 30s and 40s. These periods are dangerous. That said, if you look at the 60s and 70s now, and you look, despite having 3 recessions, despite all the inflation and the fact that people felt like the world was coming apart at the seams, it's important to note 2 things. One, GDP in real terms, not just in nominal terms, in real terms with inflation, was still above trend during that period, despite the 3 recessions, much higher than it was in real terms in the last 30 years. You would never think that, because markets went sideways in nominal terms and lost 65% of the value in real terms from 68 to 82, but GDP was above trend. Why? Because there was a demand push economy. We were sending money to the bottom, and we had a significant push in demand. That is a very different type of economy. So it's not that the economy will do poorly per se during this period. You will have more volatility. You will have more conflict. You will have poor, historically, risk performance. Stock markets will not perform as well because there is less money, less demand chasing assets, and more money and demand chasing goods. So it is a very different type of economy than the last 40 years. It does not mean the economy will do poorly necessarily. It does mean there will be more volatility. It does mean there will be more rotation. It does mean there will be more global conflict. The good news, and I'll leave you with this, I always like to leave with a good news kind of moment, is despite the fact that during the 30s and 40s that it felt like the world was coming apart at the seams, despite the fact that during the 60s and 70s it felt like the world was coming apart at the seams, we are better off for those times. They are times of rebalancing, of normalization, and generally a time where our system is rejuvenated and we resolve and make significant changes that propel us into the future. So I'll leave you with that.
Excellent. Thank you so much. And thank you so much for your time today. I really appreciate it. I realize that we went well over the hour. But again, I do appreciate your time. Everybody follow Jim. He posts a lot of really good information. And I thank you for your time. And then,
thanks for having me.
Absolutely. I hope to have you again. I have many more questions. And Ira.
Well,
Ira, I want your final thoughts. What should we as investors be paying attention to for the next 12 to 24 months? And or talk about something that we haven't gotten a chance to discuss, and leave us with some final thoughts of yours, please.
well, global macro has been my arena from the day, because I analyze capital flows. So this was a really good discussion. So where there are so many points of, as I call, I like to use Mao's metaphor about a single spark to start a prairie fire. There are plenty of places of dry tinder that are ready to go up. One that really makes me nervous is China, and not in China in the way that people are talking about, but I think the United States needs, and it's interesting, they send these people to China. And now we have Gina Raimondo, who's in China. There's always 2 things going on. They send her, but at the same time, the rhetoric ramps up. And last week, we had a very historic event. We had Japan, South Korea, and the United States meet at Camp David, and just the 3 of them. And China had an interesting response in the South China Morning Post the other morning. And it's the way I saw it. I go, what's going on here? And be careful that China doesn't feel that it's being surrounded and strangled. Be very careful, because in 1979, under Deng Xiaoping, China invaded Vietnam in April of 1979. Invaded Vietnam. Now, you really have to think about that, because China was a big promoter of the Vietnam, especially the North Vietnamese. But now that has been settled, Vietnam is unified. They invaded Vietnam for 3 weeks, and it was bloody. China lost 54,000 soldiers in 3 weeks. But they wanted to send a message to the Vietnamese: you're getting too close to the Soviets. Now you think about the irony of that, but that's historically fact. They were getting too, and back off, because we don't want to feel like the Chinese and the Soviets were at each other's throats. So the communist monolith that was promoted by the CIA only existed as the CIA when it was good for them in the 50s. But the monolith was broken. So, and China invades Vietnam, and then they pull back. And then Vietnam got the message, and they pull away from the Soviets and start loosening the binds that hold them and getting rid of some of the naval bases that the Soviets were opening that were abandoned by the U.S. So things change, and I'm worried that the Chinese are now going to believe that is taking place, and it will, based on that historical precedent. I'm worried about that, because that will result in things that we are not ready for whatsoever. There's a lot of talk, and we have to deal with the Ukraine, of course. But if China were to move on Taiwan, and not to take over Taiwan, but if they destroyed all the capacity of semiconductors that exist, to send a message back going, we're not going to tolerate this. So as Jim talked about, they need to ramp this down. And one thing that I'm watching here closely, getting away from that, but I think this is very important, because I'm one who believes that there's a reshoring going on, as we know, and we've seen Mexico. All you do is have to look at the Mexican peso, and it's something that I've talked about for years, especially with NAFTA in place. But with the reshoring, part of it is the weakness in the Japanese yen, which makes no sense to me. Why the G7 allows it? Are they doing it? And I don't know. I don't know. I'm doing a podcast in mid-September with two of my favorites, Michael Pettis and Louis Gavay. So I hope to talk more about it. That'll be on the Financial Repression Authority. So I hope to talk about that. But the yen is very, very weak on a relative basis. And yes, I know that the BOJ doesn't change its policy, but they're impacting Germany, of course, because Germany and Japan compete a lot on products and high-end products. But the yen, I'm looking at it now. The euro yen is at I'm going to tell you right now. That's the euro against the yen is probably at we're approaching the highest level since 2008. In fact, exactly 15 years ago, the euro yen, it was in September of 08, it was at 159.61. As I sit here, the high today is 159.60. So this is very interesting. And is the G7 allowing a weak yen in an effort to reshore out of China and back into Japan? Because we already know that Intel and others are building chip factories in Japan. And the Japanese have always been involved in the semiconductor. But what really interests me here is now you got the UAW threatening a strike against the big three automakers, right? With the weak yen, I think this undermines some of the UAW, because if the automakers are going to get weak because of the huge trade advantage that a weak yen provides for the Japanese, that will make the UA bargaining power less. And I'm waiting to see whether this becomes part of the discussion, especially from the White House, what we didn't talk about today, but I would urge everybody, if you haven't never read it, was Jake Sullivan's speech at Brookings back in back in April or early May, talking about the new industrial policy that the Biden administration was putting forth. And the new industrial policy has put forth by Jake Sullivan, which was, as it's come down to being now, a small yard with a high fence, by the way. So this was, I wish Jem didn't get off, because I know I would excite him, because this is a very important discussion, because as you reshore and globalization starts to change dramatically, prices are automatically going higher anyway, because again, you're going to lose the wage pressures that globalization had wrought upon the world. Because globalization was global capital chasing cheap global labor, and that's changing. But you should absolutely read that speech. End of story. It's an important thing. But if I was a Republican candidate for uh, for president, and I was surprised Chris Christie didn't talk about this, that I would say that the Biden administration is merely copying what Trump had run on in 2016. But if I was a Republican, I could say I could do this better. I won't do it with the amount of inefficiency and waste that the Democratic platform is putting into place. But this is very, very important. And because the administration is so concerned about the revival of the blue collar unions, it's all part of this, because they saw that it was that group that turned those states in the Midwest that got Donald Trump elected. So very intelligently have laid this out. Will they be able to do it? I don't know. But if I'm the UAW, I would raise the issue of a weekend, because it's impacting the profit margins of the U.S. Big Three. So I want to see if this plays out in the immediate sense.
Thank you so much, Ira, for your time. Again, everybody, thank you to everybody that attended these spaces. Please follow Ira, Jem, and Deerpoint. They all post incredible information. Also, obviously, follow Place Your Trades to find out what else we have going on over there. They got a lot of stuff going on. And again, I am just very thankful for your time, and I hope that we can have you on again.
Well, thank you, and thanks for everybody who listened. Listen, again, this is just conjecture, and some is based on others. Everybody speaks like they have the gospel. They don't. But there are things that you have to think about. Anybody who's trading or investing in this present world, you have to be aware of what are the pratfalls that you face.
And with that, thank you, everybody, and we'll see you next Wednesday. Have a great week and a good holiday weekend if you're in the U.S.